Well, I look at a lot of figures just in connection with our businesses. I like to get numbers, so I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses, and it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses. What those numbers tell me, they're interesting, but they're not guides to me. If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year, and we care a lot about the price. We do not care about the next 12 months. I've been surprised by all kinds of things in the last 10 years about the economy. I mean, I don't think there was any economist I've ever read that talked about negative interest rates for long periods of time. I mean, if you go back and read Keynes or you read Samuelson, you read any of them, they do not get into a negative rate environment. I think now there's still 11 trillion that's of government debt around the world that's at a negative rate. So we've never seen it before, and we've never seen, at least the conventional wisdom on a sustained period of long and growing deficits while the economy is getting better, extremely low interest rates, and really very little inflation. So something different is happening, but something different happens all the time. So, and that's one reason economic predictions just don't enter into our decisions. Charlie Munger, my partner, and I, in 54 years now, we've never made a decision based on an economic prediction. We make business predictions about what individual businesses will do over time, and we compare that to what we have to pay for them. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic, even if the price was right. Well, I pay none in the sense of as a guideline to doing anything. It's entertainment. I mean, it's like going to a variety show or something like that. But and I just don't know of any economist that actually has bought businesses successfully or done well in stocks. Paul Samuelson did. You may know he was a big shareholder of Berkshire, but it's they make guesses, and there's so many variables. I mean, in the hard sciences, you know that if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables, and the truth is, you've got to expect good times and bad times in business. And if you were to buy an auto dealership and you're, wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to be sure you got a good business. But you wouldn't say, I'm going to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort. It depends on a personal situation. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that. But if your house is paid off, if you don't have big living expenses, you got a portfolio of decent diversified businesses, you don't really need any cash. Yeah, I've got responsibility. We've got insurance claims. We could have hurricanes that would happen. All kinds of things where you might have to pay out billions of dollars. And I've got over 1 million people that own shares that are counting on me to run the place so we get through periods like that. But if I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children had grown, the house was paid off and everything. I wouldn't worry too much about having a lot of cash around.
Products.
Well, if you have to closely follow a company, you shouldn't own it.
Really?
No. I mean, if you buy a business, if you buy a farm, you go up and look, every couple of weeks to see how far the corn is up, and you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that. You buy a farm, and you hold it for, I've got one farm that I bought in the 1980s, and my son runs it, but I've been there once, you know. I mean, it doesn't grow faster if I go and stare at it, you know. I can't cheer for it, you know. More effort, or something like that. And I know there's going to be some years when prices are going to be good and some when the prices aren't going to be good. I know there's years when yields will be better than others, but I bought the farm. And if it just doesn't, I don't care about economic predictions on it or anything of the sort. I do care that over the years it's well tended to in terms of rotating crops, and I hope yields get better, which they generally have. In fact, that farm 100 years ago would have probably produced 30 bushels, maybe 35 bushels of corn per acre. And now in a good year, you know, it'd be 200. I mean, we've really made progress in this country. That's one reason commodity prices, if you go back a couple hundred years, they've moved so little, is because we've just gotten better and better at whether it's cotton or whether it's corn or soybeans or all kinds of things. And you and I have benefited from that. Well, it's a long-term investment, and if you own the best auto dealership in town, the best brand, and you had somebody good running it, you wouldn't drop by every day and say, you know, how many people have come in today, or, you know, I think interest rates are going up a little, maybe it'll slow down our sales or anything. No, you buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days, and you know things are going to be different from day to day and year to year. You shouldn't buy it if the day-to-day stuff is important. If I knew it, I'd have bought a lot more than 200. No, that's not a big purchase for us, actually. And now we will buy Berkshire when we have lots of excess cash. All the needs of the business are taken care of. We spent $14 billion on property, plant, and equipment last year, way more than depreciation. So we take care of the needs of the business. Then we have excess cash, and if we we'd love to do is find other businesses to buy. But if I think the stock, and my partner Charlie Munger think the stock is selling below intrinsic business value, we will buy in stock.
So it obviously was at that point.
Well, we thought so, yeah. But you know, what's really intriguing is when it goes down a lot. I mean, when you're buying dollar bills for 60 or 70 cents, which periodically you get a chance to do in stocks, then you know, assuming you've got the cash, you don't want to ever, you know, get so that some surprise could really take you out in some way. But if we've got excess cash, we'll buy it as fast as we can. But it's, you know, if you and I own a McDonald's franchise together and it's worth $1 million and you own 50% of it, and you come to me and you say, I'll sell out for $400,000.